We have with us Prasanna B, the Group Head, Global Market Sales, Trading and Research at ICICI Bank, joining in the show right now. Prasanna, hi, good morning. Good to have you on the show. Prasanna, now that yields have climbed to a 6-month high, in the near term, would you say that it's actually the oil spiral up which is stoking the yields further?
Hi, good morning, and thanks for having me in the show. Yeah, a lot of things are happening simultaneously now in the bond markets, like, for example, at the global side as well as on the Indian factors. Now, obviously, on the global side, you would be following the Fed tapering quite closely, but it's now kind of focus is shifting to the dot plots and the movement of the rate hikes to an earlier part than what was earlier priced in. Real yields have started going up, and now inflation expectations in the US have also started going up. There is hawkishness even in the euro area, with Bank of England also talking about rising rates soon. So all in all, I think on the global factors, there is a negative push upward push to bond yields. And then more of late developments are about the energy prices and the oil prices going up have also contributed to the bearishness in the Indian bond markets. As far as Indian factors, specific factors are concerned, you will agree that the growth has been quite strong, likely to be quite strong this year. We are reaching a situation where, it's a K-shaped recovery. So obviously there are some parts of the economy, it's an uneven kind of a recovery. But we are reaching a situation where easy monetary policy does not really help the right segments anymore. While I do admit that RBI will keep the rate much more accommodative for some more time, I think we are reaching an inflection point, so to speak, where RBI starts to look at normalization of the ultra easy monetary policy that they have embarked on post COVID. And I think that's one of the reasons why bond markets have started focusing on, and a little bit of bearishness has crept into bond yields.
Sure. We've also got the RBI monetary policy later this week. Just wanted to understand, what is it that the money markets are pricing?
So I think, it's always difficult to exactly find out what the market is pricing in, because there are so many people, trading. But I think at the end of the day, a little bit of bearishness, like I said, has kept in. So I think while nobody really believes that RBI will actually hike reverse repo in this policy, most of us actually believe that RBI will kind of sound out a plan for normalization, which will mean first there would be a liquidity suction tool that will be deployed by the RBI, and a gradual increase in what is called as a VRRR, where they take out liquidity for a 14-day or a 28-day period, and then they'll kind of hike reverse repo rates in December and February. So this is what most of us in the markets believe. There are some people who believe that there could be a reverse repo hike as early as this policy itself. So, but I would say when it comes to positioning, market has kind of been a little bit worried about whether there could be a hike this policy, and hence yields have reacted. And like I said earlier, the fact that energy prices have shot through the roof and oil prices have gone up beyond 80, with natural gas trading at nearly the equivalent of around $200 per barrel effectively. I think the fear of inflation, future inflation, is also, creeping back. So I think all of this is what is leading to a fear that what if RBI starts to normalize much more aggressively or much more earlier than what the market is today, currently pricing in. So if you were to hear the RBI sound out a clear roadmap and continue the accommodative path for some more time, and not hike the reverse repo on Friday, then maybe you could see a little bit of pullback on yields. But everything is, of course, subject to where oil goes, because a lot of now commentaries have started coming and saying oil could potentially go to 85 and 90. There are, of course, divergent views. People are talking about 70. And a lot of us are also expecting it to be in the 80s handle. A lot of it depends upon that as well. And the last is, what is RBI going to do on the GSAP announcements? Because they have been buying government bonds on the longer end and infusing liquidity. Now we all understand that we have reached a stage where fresh liquidity infusion by the Reserve Bank is untenable in the current scenario. So I guess they might have to come out with some kind of a GSEC taper, if you will, very similar to the Fed taper, where they gradually decrease the amount that they are buying under GSEC rather than whole hog coming down to zero. and even converting a GSEP to a operation twist kind of a liquidity neutral operation twist kind of a thing is also something that the RBI that the market is expecting the RBI to do.
So just to wrap it up, this week we have credit policy, bond yields are going higher. At what point in time, what perhaps is getting ignored, the obvious uptick in energy prices, the obvious uptick in inflation, Reserve Bank of India will have to bite the bullet because the inflation is a genie which is out of the bottle, cannot go in again.
So I don't know what you mean by saying bite the bullet, which is why I'm saying that the RBI will actually announce a normalization of the ultra easy policy that they have set path post COVID. And it is never, I mean, unless you really believe shocking the markets is a tool in itself, one really thinks that in the current scenario where all central banks are actually telegraphing what they want to do quite well and preparing the markets for it, preparing the Indian markets also for a normalization is a much better way to go forward rather than shock the markets is our personal view. And I think so that's why we are saying that they'll come out with a clear plan to say that they'll probably increase the VRRR and suck out more liquidity from the banking system. They will reduce the GSAP, but they will not yet touch the not yet touch the reverse repo. This policy, they'll probably announce or give a roadmap to say that they will increase the reverse repo rate in December and in February. And of course, maybe keep the accommodative stance for a few months more in order to ensure that the growth is, broadening from an uneven growth to a much more broadened pace of growth, which, benefits all the segments of the economy. And maybe hike repo rate sometime in June. I mean, that could be the kind of, normalization part that I would, think RBI would be prepared to do.
Okay, we'll leave it at that. Thank you so much for joining us live today on the market.